Hi everyone, welcome to our event today. My name is Brianna Toner and I'm the Manager of Client Services here at Azul Partners. We have a great program planned for you and I'm thrilled to be introducing Pawana Burlakoti, Group Product Manager at LexisNexis, and Pierre Michael, Chief Research Officer here at Spend Matters. This webinar is the second part to our two-part webinar series with LexisNexis. If you weren't able to attend our last event, no worries. And if you would like to view that content, you'll find the registration link for the on-demand recording in the Resources tab to your left. Also in that tab, you'll find a ton of educational links from LexisNexis that I think you'll find useful, along with today's slide deck. Simply click to download. On your screen now is our planned agenda for the day. We'll hopefully get to everything planned here, but I just want to invite you, the audience, to participate as much as you'd like and help direct the conversation with your questions. Simply enter in any inquiries you have into the Q&A widget within the audience console on your screen. So very quickly, in case you aren't familiar with the Azul Partners brand or Spend Matters, the Spend Matters network of sites under the Azul Partners brand is the leading online B2B resource for procurement and supply chain news. Spend Matters, one of the two parent sites, is the world's best and largest information source for procurement and supply chain professionals, enabling CPOs, consultants, and technology solution providers to make smart decisions regarding all things procurement. So with that, I'm so pleased to pass it along to Pawana to provide a brief intro to LexisNexis, and then we'll get started. Pawana, thank you so much for being here today.
Thank you, Brianna. Again, happy to be here with Pierre. It was a great session, the first one, so we're looking forward to this one as well. I'm a Global Product Manager for LexisNexis. We are one of the leading providers of the legal, regulatory, and business information, and we also provide analytics on top of the information for our professional customers. Our goal is to make sure that our customers can make informed decisions based on the analytics and the content we provide them. We are all over the world. We have coverage in around 175 countries, and that's where our customers are. We are 10,000 employees worldwide and growing. We are part of the RELX group, also sometimes known as the Reed Elsevier group. Happy to be here with you guys. And with this, Pierre, my co-presenter, take it away.
Thank you, Pawana, and thanks everyone for attending. Really excited about today's session because we have some good, frameworks and insights and things like that, but also have some great kind of operational day in the life kind of insights that Pawana is going to share. So, it wouldn't be a risk management presentation without putting some of the latest supply risks that are out there, the shock and awe slide, if you will. And there is quite a bit that is going on out there in terms of, if you look on the upper right, interest rates going up, and that's an impact on suppliers, especially if you're trying to lengthen your days payable, and working capital is a pretty big issue for for a lot of companies. So, and then in terms of economic, also just not just the Amazon effect and what's going on to companies out there. It's not just Sears, but so a lot of your B2B suppliers are probably eventually on the let's just say the digital disruption map, if you will. There's the picture there of the White House. Obviously, every time there's a tweet about something with regards to tariffs, there's a lot of folks in procurement and supply chain that are that have already been, frankly, looking at what's going to be the impact on their costs and how do they move sources of supply around, hedge and just deal with those impacts. Environmental, you don't have to look very far back if you look at Florence and the impact that it had on a lot of the food supply chains in the southeast, corridor. A lot of really big impacts there. If you look at what's happening in terms of geopolitical and what's happening in the Middle East, everything that gets kind of tied to, to crude oil. If you have a big hydrocarbon-based spend, these types of things are all going to be connected. Same thing with China. For those who are not just sourcing from China but selling into China, the trade war is not really a good thing for you right now. So you're just trying to figure out how to how to deal with that and all of its manifestations, not just the explicit tariffs, but just some of the other things that are happening and where it's harder to get into country and get goods out of country, et cetera. On the InfoSec side, on cyber, that's probably the hugest area right now, the most active area. It's not PETCHF. If you're not familiar with that, look into that. It had a $300 million impact on Maersk and other companies. Huge issue. And then finally, Brexit. And you can kind of see how these things are connected, where a lot of these regulatory issues and socio-political issues really have an economic impact as well. So a lot of issues out there, and it affects a lot of supply chains. So if you look at someone like Supermicro that sells into Apple and Amazon, just into the high-tech supply chain, and their contract manufacturers and their tier 2 suppliers, where there was, let's say, some unsavory kind of hardware that made it into the supply chain, that can have a real impact on your results. So it's not just these kind of examples that I've been bringing up, but just more generally. There's a great the Business Continuity Institute. They do an annual study. Their new one should be coming out pretty soon. Really put some numbers around disruptions, and you find that almost a quarter of companies had an adverse event that had at least $1 million of impact, on their supply chain. And it's, there's some pretty real dollars here on the bottom. An academic study about looking at that shareholder value impact. So obviously the value can be quite large in terms of these adverse supply risk events. And one of the challenges, though, is that if we've got to look at how do we fix this. In our last webinar, we asked a question around, hey, what's the biggest kind of barrier overall? And we found that 40%, said that they had issues with regards to coming up with kind of a shared enterprise risk kind of approach to this, around a risk framework, and also just not being able to get the budget or building a business case for it. So we thought we would tune this second webinar to really kind of drill into this kind of business case piece and really the transformation and building that case for change. So with that, we want to just get a little bit of insights from you guys, because it'll help kind of tailor the rest of the content that we do in this webcast. So we're going to ask you to do the following poll question. So why is it so hard to build that business case for supply risk management? So is it no really clear risk owner, natural risk owner, and budget owner? Is it you're measured on cost but not really on risk reduction, and tied into that this kind of finance-driven hard ROI kind of death march, if you will? Is it that you have regulatory compliance but it only goes so far, check the box kind of approach? Is it that you just don't really have good data and systems to automate and support it? Is it that you just have you're just constantly reacting? That's just not a real prevention mindset. Or is there something else? And if there is, please use your Q&A widget to kind of tell us what it is. That'd be really good fodder for a discussion. So, okay, if you guys can go ahead and post your final results here, we're going to go ahead and look at the results. So, count it down, 3, 2, 1. Let's see where we're at. Okay, so what are the biggest issues? So, it looks like we have a tie for no clear risk owner and budget owner, and also we have kind of poor data and systems to support this. But not close behind is kind of this: we're formally measured on cost and not risk, and to some extent there's a lesser extent kind of this poor prevention mindset. So, Pawana, maybe if you could just give me your thoughts on this relative to what you've seen at others. Love to get your insight on this as well.
Thank you, Pierre. I was trying to see if the full results are still coming in, but we do have a quite nice tie here around the no clear risk owners. And we talked about it in the previous webinar as well. Sometimes it is hard for one group to own it, or if there is already a group owning it, for them to explain that this is how I'm going to measure the risk. It is hard unless you are thinking of the risk in the same way. It is hard. So there is this idea around the shared framework. Unless everybody in your organization speaks the same risk language, you're always going to have difficulty owning and managing this process. And the data system always is, right? What can we trust, and especially in this world where we're questioning every data point we get. Is it not available, or whatever is there is not sufficient, or is it that we just don't know how to process some of the unstructured data that might come through? And how do we consume so much of the information? Sometimes it's one of those pitfalls where you want a lot of data to understand exactly what's going on, but since you don't really have a clear owner, nobody really owns processing, massaging, and interpreting that data in the way that it makes sense. So not surprised, those are both difficult tasks. Yeah.
Yeah, and I like your analogy around speaking different languages. You know, we're all trying to, maybe folks trying to do the same thing for the benefit of the company, but maybe our dialects and our acronyms are different. You know, business continuity and GRC, you know, governance, risk and compliance. You know, everybody's got their SRM. Is that supplier risk, right? So definitely is an issue. Well, I think one of those issues definitely was a perfect lead into, we had done a study with the Institute for Supply Management, and it was around kind of procurement and finance alignment, and it was about this kind of, you know, hey, what are supply management organizations kind of measured on? And we kind of said, you know, hard credit, some credit, no credit, you know, and but kind of track behind the scenes and just no credit at all, kind of moving from left to right. And so, yeah, when you see kind of savings, hard cost savings, absolutely, you know, that thing is, you know, there's some level of credit that you know, those organizations are getting. But when you go down to the very bottom and you see reduced supply risk, right, how do we protect these supply outcomes and noncompliance, what's the measurement there? And you find that the hard measurement, very low, less than 10%. And soft credit, you know, which is soft, 41%, but, you know, the majority, or basically half and half, not really getting measured on that at all. So that's certainly, that's a major issue. And I think one of the, and it's kind of at the core of this issue, which is, you know, if procurement or supply chain organizations are trying to elevate their value, you have to kind of elevate the way in which the company manages supply. And what I mean by that, this is an old framework that I had done back at the Hackett Group. You can find out online, which is called this value evolution framework. And the notion is that, you know, it's kind of like Maslow's hierarchy of supply, right? So obviously you got to keep the supply lines flowing. That's supply assurance. You want to be able to get it at low cost and be able to, you know, not just protect the supply lines, but also protect the cost side of the equation, you know, and keep that in line. But then as you move up, it's how do we protect the demand? How do we shape the demand? How do we protect the revenues and protect the brand multiple? And to do that, that means that we have to be able to protect those supply lines, but also mean that our supply base and our supply chain is aligned with our principles of how we operate as a business, and make sure that we are tying that in to how we manage the supply chain and our suppliers, and we'll talk about that in a second. But so, I mean, there's a lot of value streams here, right, that I listed those kind of four things in that bar chart, and there's a lot of value here, so I would encourage you guys will be getting a copy of the handouts, kind of go through these things and think about what's really important to you, and then say, great, for those things that are important to you and your stakeholders, great, how are we actually looking to protect it? So you might just, even in terms of purchase cost reduction, you might say, well, gosh, maybe I could find a way to reduce my insurance costs on property insurance or other types of insurance. There's things that you can, there's some hard dollar savings that you can find in this area, but there's lots of others. So like on the non-price kind of cost reduction, Pawana, you see this a lot, in terms of regulatory fines, or just, I mean, you want to, maybe you can just chime in on some of the non-price cost factors that you see out there?
Yeah, and sure. So it's one of those, an example is if you don't have a really good risk management or due diligence process in place, sometimes when you are getting audited and you get caught in this risky activities, violating some of the compliance and the regulatory, the regulations, you are fined or penalized much more severely, much more higher rate than if you had a risk management in place that you could explain, that everybody could back up and say we had a really good risk management program, but unfortunately we did not see this area of risk, and therefore we ended up in this situation. You have a much better record of getting away with either a reduced fine or a very minimum low fine. So this is, in a way, your saving strategy. Right? You're buying yourself insurance by making sure that your risk policy is first saving you from the risky activities and then the business loss that you could see based on the type of risk you're taking, and how, especially within the supplier network, you're going to lose money quite quickly if the unknown risk came through and you had no plans to mitigate it. The second one is you understand there is some level of risk. You're doing proper, strong due diligence process to monitor for risk, and something just falls to the crack again, you will most likely end up in a better off situation with a reduced penalty anyway, because you had invested in that tool and the risk management process ahead of time.
Yeah, it's so interesting. That's a great point. I mean, and it makes me think about the whole, cost of quality, and, a couple decades ago, and kind of this notion of investing, spending more around prevention and appraisal, and, an investment there is going to have a 10x payback on reducing downstream failure, quality failures, internal and external failures. And that was very focused on product quality, but, as we kind of look at the broader supply chain, and we look at, and our suppliers and suppliers, it's that similar kind of, concept, and that whole issue around cost of quality has become kind of second nature on the product side, but it still hasn't really creeped its way into, into the rest of the area. So I guess, a good offense and good proactiveness is better than is better than just reacting and playing defense. So, there's some things you can do here, certainly from a strategic standpoint, for those critical suppliers, and we'll talk a little bit about, how you kind of deem those suppliers as critical. Those ones that really have a big impact on revenue, really engage them and manage them strategically. That's what category management's all about, right? Tuning the management process to the nature of supply, not just in sourcing, but all the way through. So managing those critical and strategic suppliers in a critical way, in a strategic way, through collaboration, through risk mitigations around IP risk mitigation, through just making sure maybe it's equity stake, to kind of prevent competitors from swooping in and stealing some of your best suppliers and trying to disrupt you, all those types of things. So a good offense is certainly can be helpful. I'd probably say the biggest issue that I see with organizations in this area is just a level of disconnect and ownership, and we saw that in what you told us on that survey, which is finding those natural risk owners for the things that we want to protect, namely the things that are going to impact regulatory compliance and non-compliance. What are the things that our suppliers are doing that might impact our brand, whether it's going to be on supply chain slavery or greenhouse gases or environmental impacts more broadly, the innovation and IP risk like we were talking about, obviously InfoSec. And all of those things have kind of some natural owners in the GRC groups and in sustainability, in EHS groups, finance, IT. They're gonna take different names and forms in your organization, but some of those groups have that kind of mandate for defending the enterprise around those key risks, and those then extend out to the third parties, and they do that through supply chain risk management as we take it out to our suppliers, and that's really where you get into supply risk and getting into our supply base, and then into our individual suppliers that we engage through supplier management, and supplier risk being a key component of that. So if you look at those kind of that text in white with the bullets, make sure that you kind of take stock of who the natural risk owners are around those things, because they're going to be the ones most interested in protecting those things. And then as you go into doing an assessment of your supply risk, trying to put some numbers against it, doing your probabilities, doing your impacts, obviously, looking at the spend and the revenue impact to kind of put some weightings around that, and to, also look at your contracts and some of the other internal kind of information. Those are really going to be your stakeholders that are going to help you create the change management and the transformation of this. And sometimes you might not require that super hard ROI just because it's like the right thing to do, and there may be something already in flight where one of those stakeholders are already, looking at that and looking to implement. So as you implement, just a couple of quick thoughts, and I'm going to get this over to Pawana. So one is, look at the business impact, not just supplier spend. So it's fine to kind of start with a spend-weighted look at things, but you really want to be able to look at what's our revenue at risk tied to some of these key, suppliers. What are some, if they're touching all of our employees, is there employee safety? Are there employee safety issues? There was a client of mine, the chemicals firm. They kind of looked at profit at risk, and they actually then tied that to what their category managers and supplier managers were doing, and making sure that they had the right people and resources to really focus on the dollars that were being impacted. Very smart way to kind of to look at that, and then and then finally look at how you put a dollar, how you put a financial number around that risk, and not just to how you just transfer that to your suppliers or try to contractually, but also try to understand, what is, who's the best party for managing that risk. How do we get visibility, again, back to those natural risk owners internally, and really start to just get awareness and visibility around it. And that's really part and parcel of how you do strategic sourcing, but also carrying into strategic supplier management and category management. Everybody in procurement that does strategic procurement knows the old CrowdStrike metrics, which is, the impact of supply versus the kind of the complexity of supply. And really, complexity is a proxy for risk. The more moving parts, the more things that can go wrong, the more in which you're going to have risky supply. And so the whole notion is, how do we not just plot suppliers and spend categories against that based on dollars, but looking at total impact and looking at the supply complexity. And if you can reduce the impact through resiliency and having playbooks and being able to recover quickly, the ability on the other side to do prevention and kind of reduce those complexity factors, sole sourcing, these types of things that are put you at risk, and then more broadly agility. How can we move more quickly and also have just that kind of outside in kind of knowledge and intelligence, and then once we get that, be able to move quickly to kind of then mitigate that risk and do it faster than our competitors, because it's like that old African parable of, you just need to be faster than the person next to you. You can't outrun the lion, but as long as you're faster than the next person, the lion's going to get the other person, not you. And I mean, that's kind of the risk side of it, but it's the same on the reward side of it. And that's really the importance of having that supply market intelligence, piece of it. And that is where the last kind of thought I'll leave you with is kind of this, the fact that supplier risk management, kind of powered with good, market intelligence and aligned back to enterprise risk management, really plugs in at multiple points through your sourcing and supplier management, kind of life cycle. And if you're going to do supplier information management, part of that is supplier intelligence, right? And using that to inform decisions for both reward to drive into sourcing, but also to on the prevention side, on the risk mitigation side. And if you look on the bottom, there's a lot of places where that risk management should be getting injected, all the way from risk analysis up front when you're doing your analysis and sourcing, getting it within your category playbooks and your category strategies, your supplier risk monitoring, using the risk scoring within strategic sourcing, which can actually give you some leverage in negotiations when you're scoring the suppliers on risk, and you're actually working with your stakeholders to actually score risk against the things that are important to you around on-time delivery and innovation and those things that you want from that spend category and from that supplier. And then also risk, as you get into the ongoing, obviously, qualification, certification, screening, and then into your ongoing kind of active supplier monitoring, and that really ties into all of these processes. So supplier risk and supplier risk is really an active management process that really ties into this whole area, and so it makes it scalable. And if you're going to scale, there's a lot of pieces to that, right? So one is have a good framework. You saw that on that previous slide. I mean, I love PESTLE. I've used, it's a standard framework. It's been out there for a while. LexisNexis uses it, which is great. It's very all-encompassing, and it's easy, for you and for stakeholders to kind of remember. So it's one of those things where, hey, why reinvent the wheel? If you kind of, and we're actually going to be, and Pawana is going to be talking a little bit more about this in detail. So as you really get into getting into the heart and the meat of this kind of what we came to talk about, this kind of business case piece of it and transformation, kind of giving some broad guidance, but it is good to really go through all of those individual business case elements. So one, insurance costs. Depending on, like for manufacturers, if you have a lot of inventory, if you have a lot of property, plant, and equipment, a lot of CapEx, there's going to be some insurance that hopefully you're carrying, and if you do, you're probably spending some money from that. So, whether it's 1%, 5% of your inventory or, whatever you're paying, there are some ways to reduce that, just like, putting a monitoring device on your car can reduce your premiums and deductibles for your auto insurance. You're finding the same thing with a lot of the progressive, kind of insurance companies out there, the Zurichs and Allianzes and whoever, and by working with them and working with third parties of all sorts, there's good, consulting, specialized risk management consulting companies, or just the actual solution providers themselves, that are using these diagnostics on the front end, like LexisNexis and others. These diagnostics are really really valuable because they help you kind of tease these things out. And on the insurance costs, I've been doing a little bit of research because there's not a lot published on this, but found that you can save up to 5% on your premiums and your deductibles just by going through a diagnostic and doing some of the basics with these with some of these more progressive insurance providers. Personnel costs, there are potentially some opportunities here, but it's not really a big headcount game. This is really more around strategic kind of costs and really impact on the business. But as Pawana was talking about, there are a lot of kind of larger total cost kind of elements in terms of cost of quality. There's regulatory fines, and frankly, a lot of times people just kind of ignore the fines until they get bit by them. And it is important to run these models so that you can say, great, well, let's adjust that probability from 1% to 0.5%. When you still add it up at the end of the day, it ends up being a really big number. And that's really what you see like when you do the next two elements around supply chain impact and kind of revenue impact. Particularly when you have critical production or service providers that, if there's going to be an impact to them and that is down and you can't deliver to your external customer, and that's going to mean customer penalties or lost sales, really good to put some numbers around that, because too often we just, kind of stay focused on the spend piece, which is fine, but it's only one part of the equation. And those kind of penalties, it's not just the actual regulatory bodies, it's the legal fees, it's all of the internal things that you have to pay to really deal with, the consultants and the auditors. You want to be using auditors up front and special, kind of specialist consultants up front for diagnostics rather than on the back end. And little guerrilla tactic I've learned from folks is, take internal audit and your risk management folks, take them out to lunch, and really get engaged with them, because it's much better when they are driving a lot of this kind of third-party risk, supply chain risk, and they find a material, finding that quite often can get a lot more, eyeballs and action than maybe it's just coming from, say, the procurement or supply chain, organization. So anyway, there's a lot of cost elements here. There's cash impacts. And obviously there's brand impact, which you may want to at least have in that case. So by really making sure the business case is holistic, then you can really at least start to at least get everybody talking the same language about the what ifs and the scenario planning. And scenario planning is a strategic, it's part of business strategy, right? So, it's real life stuff. We have a client, so as Brianna mentioned, part of our, one of our other businesses is a company called Metal Miner, and we deal with metals companies and metals buyers. And a lot of these things are all connected. So if you look at what is happening in terms of not just tariffs, and what's happening to costs and capacity. So as everybody, rushed to go, okay, let's lock up some domestic supply with the 25% tariffs on steel. Great. Well, now, there's no more supply. So now we got to go to Europe. And, for the people that were ahead of the game, they've already kind of locked up some of those long-term agreements rather than having to go out there, pay spot prices. And there's some real money on that. So there's some quotable quotes, a couple from Metal Miner. There's a couple, one's from an NGO that these are all very recent, that was talking about cobalt within the supply chain. This is extending past the traditional kind of conflict minerals, and just taking a look at that multi-tier supply chain that you might have. And one of our clients, they were doing business with Rusal, and they didn't even kind of realize that they had a couple of key spending areas where the aluminum category manager left, and they didn't really realize that this major supplier that they had sole sourced to on a couple of areas, a couple of components, and they had to do a major scramble to kind of go and find some alternate supply. So you don't want to be, these things connect together, and if you kind of have some better visibility on some of these regulatory things that are coming down the pike, at least you can just be ready and start exploring some of those things earlier rather than later. So, okay. I am going to pass this over to Pawana, and she can take you a little bit more into the PESTLE framework, and then we'll kind of talk about some of the good meat and potatoes kind of guerrilla tactics on implementation. So let me just remind you, if you have any questions here, do send them in on the Q&A little widget, and we'll kind of get to those in the Q&A section. So, okay, Pawana, take it away.
All right. Thank you, Pierre. So when we talk about how do you, tackle this, a lot of it is around that you understand the theory and the concepts behind the importance of having a good risk management strategy in place, having the right owners identified, right, and then all the tricks that and techniques that Pierre has shared. And also, what is the cost if you don't do it, right? You always have a choice of not doing anything. And then what are the costs, the various areas of, direct, indirect, the hidden costs that you're going to face. So we try to put in a framework that makes, kind of a common sense framework. Once we go through all of them, there is really no secret, nothing hidden here. It's just that it is grouped in such a way that it makes more sense. It's a logical sense to group certain things. But if you think about why do you need to separate and bucket the risk, there are a lot of these things, these four things that are floating around that circle, that wheel, around the financial, the strategic, regulatory, and reputational. What we are trying to talk about here is those are your external drivers for why you might end up in a risky situation. So you have this, big regulatory, this financial and reputational, some risk-driving enforcement. So you have something you have to comply with, you have to do something. Then as an organization, your monitoring and your risk management and diligence process increases. There's an increased burden for you to comply and do more. But you don't really have either the right owners or the right skill sets or the right tools to actually properly manage this risk and perform an analysis. And what you end up happening is this every department doing their own kind of risk management in their own way with different thresholds for risk, with different weights put into certain risk factors. And you end up with this siloed system. We're talking about, both in terms of department and the process as well as tools. So some of the companies have multiple risk management tools. They don't talk to each other. The tools don't talk to each other. The departments are not talking to each other. So you end up in this silo over time. And there is an increased cost to that. There is a risk from all of this happening, but there is a cost in maintaining different processes, different systems, different tools, and the impact of it is that at the end you are in a very inefficient risk management process, which again means that you're going to slip somewhere and you're going to have more regulatory requirements to be in compliance, and then the cycle just keeps going around and around. So to avoid that kind of cycle, we try to promote a shared framework of understanding. We call it PESTLE. It stands for political, economic, social, technological, legal, and environmental. Under that, there are various things around political risk, things that are outside of your control. The nationalist movement going on, change of government, elections. Those are things that businesses do not have direct control over, but they are at the end of the recipient list where they are facing the burden, the impact of some of these changes. There is big economic risk. Sometimes there is economic risk around your exchange rate. And if you're doing business globally and exchange rate goes up and down, there is a country whose economy is failing, you are going to be impacted. Sometimes it's direct, your simple as rate, interest rate going up. Sometimes it's much more bigger. Right? There is a ban against doing business with certain companies. So it has a major impact on your supply chain. Social, and Pierre talked earlier about unfair labor practices and inhuman treatment of the labor force in certain industries. It can happen in high-tech industries as well, where companies don't offer either the right compensation or they don't have right breaks or number of hours that they honor. Sometimes it's more more deeper than that. Right? There's a cultural practice that certain companies might encourage versus others. And technological, it's a little bit broader, so it's not just technology that you apply or use within the company, but it's also operational. There's a port strike going on, labor strike going on. There is unions forming. Unions are not allowed to form. A lot of those things has an impact on the business. And then there's the legal risk. This is probably a little bit more well-defined. Legal risk both in the place you do business and where you have customers. Sometimes you have to comply to do business or to sell your products and goods and services to a different country, different customer. You have to comply with their regulations. And then you have your environmental impact. Sometimes it's simple. It's a natural disaster. There's a greenhouse emission program. Or sometimes there's a regulatory driver where you are forced to make certain choices around, what are you going to prioritize? You cannot manage all risks all times with the same priority, so you're going to have to give some in order to do something really, really well. Sometimes it's around reputational risk, and if you're not reducing your carbon footprint, for example, you're going to be penalized by your customers, by your consumers. And so there's different kind of regulatory drivers externally and both internally that customers have to work hard in managing. So what does this look like, right? How do you touch and feel this? A lot of this just seems like something that's very theoretical. You learn in a classroom, and you need to really learn how to implement this in your company. So using a PESTLE framework, it's about putting the key suppliers, the ones that you think are the most critical, either in terms of your categories or your tiering system, into this ongoing risk management program. You don't want to do this once a year, twice a year, or once a quarter, or whenever the supplier QBR is coming up, you want to go and see what you can find about them. This really has to be proactive for this to give you value. And it has to be done in a way where we talked earlier. First, you don't really know who owns it, and you don't even know if everybody understands it in the same way. And there is a lot of trust issues and technology issues around data, the accuracy of the data, and how well you can manage the data. And if it's coming from multiple sources, multiple vendors, and they all are in a different format, for example, what do you do? How do you really do a proper analysis when your data is not coming to you in the same way? So the way we promote this practical implementation is to standardize the data and wherever possible, score the data. That way, it is not just up to your subjective analysis, and if this news or this event is really risky for me, let the customer, let the experts interpret the data for you. Right? Take the help when you can from technology. There's really advanced, machine learning AI tools available in the market today where they can process billions of documents and being able to give you a summary of what actually the event is about. How bad is it? Is it a really high-risk event? Being able to pinpoint between data points to say, hey, there is a risk event happening here in this supplier, but the downstream impact of it or other companies that are impacted by these are, ABC. And I will walk you through all of those examples. But first, have a tool that explains to you risk in a grouped way. So we have the 6 different groups. And also have a tool that is doing this work for you, that is collecting data real time, that is analyzing data for you over time, and that way you see your full risk portfolio. And it can be done in a really large scale where you're monitoring all of your suppliers, or it can be done based on just 1 or 2 categories. And so once you're collecting data, once you've decided who you want to monitor, which of your suppliers you want to monitor, your third party, what do I do with it? I see a lot of data points, right? So the way to look at this is what are the risk factors that I need to be aware of? So this is just an example of the dashboard I built based on various companies, really no industry focus at this point. I see a lot of legal risk going on. There is a couple of high economic risk. You see that red, the bubble, and then something that's low. So you as a category manager or your supplier risk manager, you might decide that I don't really have the bandwidth to focus on the low risk and the medium risk. But I do need to investigate further what lives within the high risk. And the way we group them is based on the topics. That could be high risk. So when somebody has suits and claims, you might say it's low risk because, of course, it could be false. It could just go away. It could be settled. It could lead to nothing. But when something is around bankruptcy, there is a really concrete impact that I need to follow through. So once you decide what it is that you want to monitor, you want to deep dive on, this is an example of just a single supplier, single risk profile. You're looking at one company where all the risk is living, and I see that, this highlighted bubble on the top, there's economic going on. I also see something happening. So the Samsung, they haven't really filed for bankruptcy, but I start seeing some, financial impact that could be risky. And they also happen to be talking about bankruptcy and what is going on, right? So you might just say, I don't remember Samsung being titled bankruptcy. So once you start analyzing further, you end up in this situation where what really happened is that Sears has filed for bankruptcy. Samsung happens to be one of the major suppliers for Sears. And you also find out from reading the content that not only are they one of the key suppliers, they are also not in the line of creditors. So if when Samsung is going through the bankruptcy filing and the payout to all of their suppliers, Samsung has a lot to lose. So there is about 20 others along with Samsung. So there's Whirlpool, Frigidaire, and they are unsecured creditors. So there is, depending on how much they have in credit and all, you can see that there is a large financial impact that is potential that's going to happen for Samsung. So if you were, buying phones for your company, for example, through Samsung, and there is going to be a big financial impact, you want to have an honest conversation. Is Samsung able to absorb that cost, or are they completely to departments and you don't really have an impact, but at least you have visibility into the information that you couldn't have gotten directly out of just monitoring for Samsung. So this is again going down all the way to the metadata around what really drives risk. How is this news here tied to my economic risk? How is it? And then you can say, well, it's economic risk because it has bankruptcy and Chapter 11 and those kind of terms tied to my risk. And then you can say, well, out of the 6 framework of risk I'm going to monitor, let's just say you pick social, economic, and legal risk to manage. And this happens to be one of your priority areas. And this is when you are at disposal of a concrete data point that you can share with your stakeholders, with your other groups who manage risk, to say, this is a high-risk event, and what is our plan against the risk mitigation here. So, Pierre, I think this is going down to this is understanding. Again, another slide is to talk about if you have hard time explaining the metadata. We do provide additional knowledge that can be shared across to say, hey, it's not just about bankruptcy, but this has, tied to Chapter 11. And this has, there's a business insecurity, the insolvency risk. So what do you want to do about all of these things that are happening? This is around the implementation of it, right? So, Pierre, I'm going to hand it over to you to say, now, how do you take this example that I walked you through and then implement more broadly across your supplier base?
Thanks, Pawana. I definitely have some questions for you. That was really interesting, kind of the flow, which you kind of drill it down and then drill over to the supplier, and then kind of get into the metadata. Yeah, so I want to just kind of give. It's hard to kind of be perfectly prescriptive around how you do this, right? Because a lot of times it might come from if it's going to come from the head of supply chain saying, hey, we need to do supply risk, that's terrific. If it's going to be coming more, bottoms up, you can, let's say for around supplier risk, you can certainly start there. I do find that quite often procurement organizations focus a bit too much just on the supplier financial risk piece and don't really look at just the broader risk kind of, inputs, but certainly I can understand, you don't want to be caught with, a supplier that's gone under and you had no knowledge of it, but obviously it's a lot broader than that. So, a lot of times the supply risk programs will start as extensions of enterprise, risk management, and it might be called third-party risk, or it might have kind of more of a regulatory compliance kind of bent to it, and not just from regulatory agencies, but also from your large customers that are saying, hey, if you're going to do business with us on InfoSec, you need to be ISO 2000, 27001, whatever, certified. So a lot you'll just kind of inherit from big customers, as well as kind of what you inherit from the regulatory bodies in force for kind of where you operate. So it might start from that side. So there's no kind of one place to start, but there is generally a common process that you find when you go through it. So one is, I'd say before you kind of go to step 3 and 4 and just starting to hey, let's take, do the big diagnostic and take that full inventory of risk types and, right to the supply base, it is good to kind of just scan around all these stakeholders in terms of where there are risk issues. And I would certainly start with, if you have a head of risk management, if you had someone that's responsible for GRC, work with IT, let's say on the InfoSec, really get the key stakeholders here that have, a real stake in the ground. And part of it is just better coordinating how they all go out to suppliers. So just for supplier management and doing risk management, there's just better information management flowing both ways, right? Just like in CRM, you have a common, kind of face to the customer. It's the same thing on the supplier side, and so making it just more coherent in how you manage them, because they're managing you most likely if they're a large supplier. So just getting better coordination with these stakeholders is a great place to start, because quite often there are projects that are in flight, and also they might have some budget, that they can have, and maybe it's in, a consulting budget or, wherever. Sometimes you got to just find where those little pockets of money are that actually, where they actually are, and see whether there's some energy behind them where you don't have to go through some kind of really excruciating ROI analysis. So look for those burning platforms, and I call it kind of organizational judo, right? Use that momentum to your advantage. And as you, just even from a procurement and supply chain standpoint, as you kind of work with your business units and the budget owners, and as you talk to them, let's say you're engaged with them during an annual kind of process when you're doing business planning with them, or just as part of your relationship, really ask, what are their key outcomes? What are their KPIs? And then you translate that right to the supply base and to the supply markets and your supply chain, and then say, great, let's see if we can map that out and see where there's the biggest exposure. So for a high growth company that's, focused a lot on, protect the revenue and just grow the supply base to support our growth, that's a pretty big issue and a very direct connection. Okay, but then once you actually go and take that inventory of risk types, it is good to have a common framework, because quite often stakeholders have different frameworks on their side. So the more it's just kind of like, spend analysis with different spend categorizations or different GLs, the more in which you can just kind of unite everybody and take what they've done and invest a little bit to kind of crosswalk it to a common framework is really useful to kind of bring everybody together. And obviously, as you go through this process on each of these, you want to be checking in with the stakeholders and making sure that they're kind of coming along, with you. And then once you kind of take that inventory of the risk types, and do not over-engineer this. The more engineers, actually, the more engineers you have, the more in which it'll slow you down in terms of just trying to get so granular on the risk probabilities and the impacts. Get some general kind of view into this, and then immediately start to validate that, with those stakeholders, and say, great, let's adjust the probabilities, let's adjust the dollars, and just kind of get that buy-in, even if the total price has to come down a bit. And then once you do that, now you can get into that kind of RACI model, which is this accountability matrix, and say, all right, who are the ones that are really most the natural risk owners? In other words, they're the ones that kind of have the thing that's going to be impacted, as well as the ones that need to focus on some of the related risk types. So, for example, the CIO is going to be really key around InfoSec and information risk, and how do we, best protect that. So they own kind of the budget side on fixing it, as well as kind of the outcomes around that particular area. So you want to then kind of engage with them right around making sure that somebody is going to own it. And if nobody chooses to own it, that you are explicitly getting them to kind of sign off on the fact that you're going to be basically non-protected, so that when something comes around, it's not like, saying, hey, if you have to sign on the dotted line, although a couple of companies have actually done that, get people to kind of sign off. When you actually get to that level, you'll find that people do get more engaged, because if you look at behavioral science and economics, people are very risk averse, right? And they will not want to be the one that's on the hook for causing, not protecting themselves against a major issue. So again, check back in with those stakeholders, and then start, getting into the implementation. And there's various ways of kind of, doing this. And this is actually where I had kind of a question for you, Pawana, because I've seen it in lots of different ways, and I'd just like to see what you're kind of seeing out in the field. Some companies will be like, oh, let's look broad, come up with our, quote, critical suppliers, like you do in SRM. What are my strategic suppliers? Hey, what are my risk critical, suppliers? And then from there, kind of apply some additional rigor and monitoring and whatever. But then others are kind of more category specific in how they address it. But what are you seeing in terms of just how companies are typically attacking this, either big or kind of starting small and iterating, et cetera?
Yeah, I think usually from our own customer experience, we see them as almost for the very first time they have decided to do this, tool-driven risk management process. So they do tend to start out really, really small with the critical suppliers, about 100, 200 of them, mostly capping out around 500 of those core suppliers. And this is for, let's just say, a company that has about 20,000 plus supplier base. And so they're starting really small. They're using the system pretty intensely to look for every event, and over time they know what their baseline is for risk for the suppliers. And then that's the point when they tend to increase their coverage for which companies they monitor the risk for. It's also sometimes industry-driven here. So there are in certain banking industries, insurance industries, where they have to monitor suppliers and that touch, let's say, customers. And then at the time, they're just going by which one has a direct customer impact. And then at the time, the volume is not so important. They're looking for everybody who's under that bucket of that suppliers that has to be monitored. But we do encourage those customers who are especially maturing their supplier management program, and then now are looking for the evolution. They're ready for the supplier risk management. Then they do tend to start really small with about 100, 200, and then scaling up after a year or so.
Right. Yeah, that makes a lot of sense. Actually, yeah, that financial services one is a great example. I was talking to a company, and they had like big U.S.-based financial services, and they had like 200 people that were doing nothing but kind of, basically know your supplier, kind of supplier, risk, particularly around, anyone that touched the systems, anybody that came on site. And I mean, that is a lot of headcount just doing supplier risk and monitoring. So that was a pretty clear area of investment. I want to kind of just put a note out there to the audience. If you guys have any questions, definitely do submit them so that we can kind of get your questions here as part of Q&A. And actually, I will let's put the Q&A slide here. But Pawana, I just another question. In terms of like how, I guess two questions. The first question is, do you find that people who are using your system, that like the user base grows? In other words, maybe it starts with someone who's responsible for supplier risk or whatever, but then they start turning the keys over to the stakeholders themselves, someone maybe in IT that wants to monitor their IT suppliers, and it starts to kind of, radiate and start to, to go to the stakeholders themselves. Do you see any kind of, evolution of the people that use the system?
Oh, yes. Yeah, we do see that, and then we try to manage that by giving, the user base a different level of access. So those who are just stakeholders, they're worried about just their set of suppliers. They don't really worry about, any of the configuration, the setting up, or anything. They just want to know a dashboard and where the risk level is. They have this kind of a view-only mode, and we see a lot of those users, in fact, within an organization where these are stakeholders worrying about just their suppliers that they're interested in. What we also see is just looking at the customer engagement. There is the very beginning, right, the exciting phase for us when a new customer comes on board, but the customer is a little bit hesitant to do a lot within the product. And then there's a warming up period, and then they are quite engaged with the product. They are trying to see how they can tweak. They want to look at their one supplier deep dive versus a bird's eye view. So it's really interesting for, me being a product person to see how customers do evolve over time. And usually what we do see is also extension of the coverage of this tool to cover other departments that were not part of the department first, right? So when they first went live, they might say, we're going to cover just for IT. And then they might say, well, we need to start covering for, HR. We need to cover for other departments as well. So that's how they usually, that's around the shared framework, right? Once another department also buys into the framework, the PESTLE framework, that's the way to monitor the risk. And that's how they expand it. And another thing here that we also notice is because there is so much information there and so much of, this AI learning happening, but at the end, it still needs the human to consume and process and decide what to do with this information. So we see a lot of push towards automation, a lot more push towards the robotic, there's some process automation that we keep hearing about. And can you just, apply a couple of, formulas and macros and algorithms on your data, and then just tell me at the end, the tail end, the output of what you found out. So we do see a push towards that, and that's usually when the customer has expanded the coverage across departments, and, it's a really, truly global risk management operation.
Well, I think that's great insight. I think the discussion around AI and machine learning, just around supply market intelligence, is probably a topic in its own right for another webinar. But I really liked the demo flow around it just kind of got my mind reeling around kind of how a category manager could really use this to kind of tune some of the categories and subcategories to the related supplier populations, and then kind of the things that you want to measure and really tailor that, kind of market intelligence to the nature of the category, and then kind of have the specific suppliers with kind of the customized, monitoring, and then really be able to just reduce it to the critical stuff to really actively, and then maybe pull in the specific data feeds and APIs around, the financial risk or environmental stuff or whatever, and really just tune it to those critical things rather than, because there's just so much information out there. I found this really useful. We're up at the hour here, so actually I'm getting the virtual the virtual hook from Brianna. So I'm going to have her wrap up the webcast and close us out.
Awesome. Thank you guys so much. That is the conclusion of our webinar today. Just want to thank you, the audience, for attending, our wonderful speakers, Pawana and Pierre, for the great discussion. And I also want to extend a huge thank you to LexisNexis for making today's event possible. We can't put on events like this without the gracious support of our sponsors, so thank you again, LexisNexis. That's all. So thank you so much. Have a great day, and we'll see you next time.
Thanks, everyone. Thanks, Pawana.
Thank you.